Hello traders, join us in this video as we discuss the correlation between the bonds and the US dollar and also how to apply this relationship when you are trading Forex. In a different video, we highlighted that intermarket analysis provides a framework for understanding the relationship between different financial markets. One of the vital connections in this analysis is the relationship between bonds and the US dollar. This relationship is crucial for Forex traders who can use these correlations to enhance their trading strategies as well as their profitability. Bonds, particularly the US Treasury bonds, play a significant role in shaping the value of the US dollar or the value of the US currency. When bond yields rise, it typically signifies a strengthening economy and expectations of higher interest rates. Higher interest rates attract foreign investors seeking better returns on their investments, thereby increasing demand for the US dollar as they need to purchase dollars to buy US bonds. As a result, this increased demand for the dollar leads to appreciation of its value. Conversely, when bond yields fall, it often indicates a weaker economy or expectations of lower interest rates. Typically, lower interest rates make US bonds less attractive to foreign investors, reducing the demand for the dollar as investors look elsewhere for better returns. This decreased demand for the dollar often leads to its depreciation. At the same time, the Federal Reserve monetary policy decisions are a key factor in influencing bond yields. When the Federal Reserve raises interest rates, bond yields typically rise, attracting more investment in the US bonds and strengthening the value of the US dollar. On the other hand, when the Fed cuts interest rates, bond yields usually decline, making US bonds less appealing and also resulting in weakening of the US dollar. Forex traders can use these correlations between bonds and the US dollar to their advantage in numerous ways. By closely monitoring bond market trends, traders can anticipate potential movement in the currency market. For instance, if a trader observes a rising trend in the US bond yields, they might expect the US dollar to strengthen. This expectation can inform their trading decisions, such as going long on the US dollar against other currencies such as the euro and the yen, among others. In addition, traders can look at the yield differentials between the US bonds and foreign bonds. Typically, a widening yield differential, where US bond yields rise relative to foreign bond yields, can indicate a strengthening US dollar. As such, Forex traders might use this information to position themselves accordingly, that is, buying the US dollar and selling currencies with relatively lower yields. On the other hand, a narrowing yield differential might suggest a weakening US dollar, which should prompt traders to sell the US dollar and buy higher yielding currencies. The relationship between bonds and the US dollar provides insight into market sentiment and risk appetite. Typically, during periods of economic uncertainty and heightened market volatility, investors often seek safe haven assets like the US Treasury bonds. This flight to safety can drive up bond prices and lower yields. While the immediate effect might be a weaker dollar due to lower yields, the long-term effect could be an eventual strengthening of the US dollar as investors continue to seek the safety of US assets. Forex traders can utilize technical analysis tools to enhance their understanding of the bond-dollar relationship. For instance, they might use moving averages, trend lines, or other indicators to track bond yield trends and correlate them with the dollar movements. Typically, by identifying patterns and trends, traders can make more informed predictions about future currency movements. Further, geopolitical events and economic data releases can significantly impact bond yields and the US dollar. As such, Forex traders should stay informed about key economic indicators including GDP growth, inflation rates, and employment figures, as these can influence the Federal Reserve's policy decision and consequently bond yields and the US dollar. Similarly, geopolitical events that increase market uncertainty can lead to shifts in bond and currency markets. For instance, a strong US jobs report might lead to expectations of higher interest rates, pushing bond yields up and strengthening the US dollar. On the other hand, geopolitical tensions or trade disputes could increase demand for safe haven assets like the US bonds, initially lowering yields but potentially leading to a stronger dollar over time due to continued safe haven flows. By integrating intermarket analysis into their trading strategies, forex traders can develop a more holistic view of the markets or an holistic view of market dynamics. This approach not only helps in predicting currency movement but also helps in managing risk and identifying trading opportunities. Traders can use bond market trends as a leading indicator for currency markets, thereby enhancing their ability to make more timely and profitable trades. As we conclude, we have to mention that the relationship between bonds and the US dollar is a fundamental aspect of intermarket analysis that forex traders should exploit for profitable trading opportunities. By understanding how bond yields influence the dollar and incorporating this knowledge into their trading strategies, forex traders can anticipate market movements, manage risks, and capitalize on trends. Thank you for watching. Let us interact again in our next trading video.